Is PayPal, ticker symbol PYPL, a good stock to buy now? Welcome to Global Value. In today's video, we're performing a fundamental analysis of PayPal using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what PayPal is worth in today's stock market. Plus, I'll share a special bonus that could be the deciding safety factor when adding PayPal stock to your portfolio. Right now, PayPal trades for $63.52 per share. In its last day of trading, it's up 0.30%. However, in the last year, PayPal stock is down 1.3%. This is well under the S&P 500, which has returned over 20% at the same time. In the last 5 years, PayPal is still down 79% from its all-time highs hit back in 2021. However, since being spun off from eBay, PayPal has actually compounded at 6.3% annually. They beat the market up until the beginning of 2023. Since then, they've continued to go lower as the market has climbed higher. Today, PayPal trades $13 above its 52-week low. This is also down $13 from its 52-week high. And how big is PayPal? Right now, they have a $66 billion market cap. Today, Ken Griffin is the biggest investor with the holding in PayPal. That's worth $549 million, and it makes up 0.5% of his portfolio. He first bought the company in the third quarter of 2015. Since then, he's been very active, buying shares 46 more times and selling 46 times. Recently, he's been loading up on shares, buying almost $9 million in the last 2 quarters. Now, starting with metric number 1, we want their average return on capital to be greater than 14%. Over the long run, it's these numbers that are going to drive a stock's returns. The average company earns 7% returns on capital, so we can build in margin of safety by doubling this. PayPal has returned low double digits on capital in all 5 of these years. They've been increasing a little bit since 2020, and in their last 12 months, they were actually at 15.7%. But when we average them out, they come in at 13%. That's better than average, but it's just very slightly below what we wanted to see. This is an X on our first metric. Now, you're probably familiar with the name, but what does PayPal actually do? PayPal was spun off from eBay in 2015 and provides electronic payment solutions to merchants and consumers with a focus on online transactions. The company had 426 million active accounts as of the end of 2023. PayPal also owns Venmo, a person-to-person payment platform, and Braintree. PayPal was founded in 1998 by Peter Thiel and Max Levchin, and it merged with a company founded by Elon Musk. Musk was even PayPal's CEO for a time. Next, we want sales, earnings, and free cash flow growth. This is all or nothing. In the last 5 years, PayPal has grown their sales by 71%. They've also grown their earnings by 76% at the same time. That's great, and they're seeing slight margin improvement. The company's free cash flows, while they've grown 48%, haven't grown as fast as their sales. This is because PayPal has lowered their take rate in recent years, as competition has heated up in the digital payments industry. Still, all 3 of these are up. It's our first check of the day. PayPal is also owned by 5 super investors, and this is led by Pat Dorsey, who has 9.44% of his portfolio in the business. Monish Pabrai also has a PayPal holding through his Wagons funds. Next, we want to see PayPal from the view of an individual shareholder. Here, we want to see earnings per share growth. PayPal has both grown their earnings over this time and they bought back shares as well, reducing their share count by 8%. This is a 1-2 combo that's increased their EPS. They brought in $3.84 in 2023, and in their last 12 months, they brought in $3.98. That's grown nicely, and it's another check on metric number 3. Metric number 4 puts our last 2 metrics together, and it's even more important. Here we want free cash flow per share growth. This is also the case for PayPal, and it's another check. Their free cash flows have grown by 48%, and with their share buybacks, their cash flows per share have grown even faster. Now let's look at PayPal's balance sheet. Wonderful companies can earn high returns and grow without using a lot of debt. PayPal is no different. They have negative net debt, which means they have a cash pile left over on their balance sheet. They finished with $2.2 billion in 2023, and today they have $2.66 billion. In their last 5 years, they brought in around $23 billion of free cash flow in total. These numbers look great, and it's a great financial position to have. It's a massive check on metric number 5, where we wanted their cash flows to cover their net debt. Now, why don't we look at our bonus before we figure out what PayPal is worth? The godfather of value investing and Warren Buffett's teacher, Ben Graham, wanted to see a current ratio greater than 1.5 times. PayPal isn't at this level in any of the last 5 years, and they're not there today. While it's a little different for a digital payments company, and this isn't something to be too overly worried about, it isn't quite at that ratio we wanted. This means it's an X on our bonus. Now the big metric of them all, metric number 6, is also today's first valuation. We want PayPal's average cash flows divided by their enterprise value to give us a yield greater than 5%. That's in line with the historical yield from the S&P 500 and is slightly above the 10-year treasury. Today, PayPal has a $63.5 billion enterprise value after we add their market cap and their net debt together. This helps us look at the company like it's a private business. In an average year over this time, PayPal brought in $4.58 billion. When we divide that by their enterprise value, it means the company has a 7.2% average free cash flow yield today. In their last 12 months, they brought in $4.98 billion. When that's divided by their enterprise value, it gives us a 7.8% current yield. These are both better than what we're looking for. They're above 5%. This means it's a check on metric number 6. Don't just buy PayPal. Watch the next 2 valuations before you stay till the end of the video for their final fair value and rating. Next, we're using a discounted cash flow model to give PayPal credit for its growth. We're taking their cash flows and using historical assumptions to grow these into the future. It's up to you to do your homework, but we'll assume PayPal grows their free cash flows at 10% in each of the next 10 years. Then in the next decade, we'll assume this growth rate is cut in half and they only grow at 5%. Plus, we'll add in their tangible book value to give an estimate of their net worth. If we're looking for a market-beating 15% rate of return, which is what Warren Buffett wants to see from his investments, then today a DCF valuation with these assumptions says PayPal is worth just a little more than its stock price, up around 26 cents. Keep some key points in mind. The first, PayPal has been very predictable even after losing their contract with eBay. Second, the company trades at the low end of their historical valuations. Right now they're trading just 2 times enterprise value to sales. PayPal is also just below 20 times price to owner earnings. Their value depends on their cash flows and some future growth, but they're in a very high growth industry. Low valuations and future assumptions are why a GF value comes in at $97.58. That's $34 above their current stock price. Now, Buffett likes the numbers, but it's the qualities of company he loves even more. Let's learn what these are for PayPal through a long and a short thesis. Let's start with the long thesis first. Number 1, there's still plenty of runway for growth in electronic payments. Electronic payments only surpassed cash payments on a global basis a couple of years ago. Number 2, the scalable nature of the business should allow PayPal to improve its margins over time. And number 3, PayPal's long-running experience in online payments is a unique asset that's become more valuable as e-commerce becomes a bigger piece of the pie. Yet, it's not all positives. Let's look at a short thesis as well. Number 1, the separation between online and point-of-sale transactions is blurring, and PayPal may increasingly come into competition with larger companies in the future. Number 2, Alipay and WeChat provide examples of how governments could favor local players. This could shut PayPal out of a number of emerging market opportunities. And number 3, opportunities to monetize Venmo could be more limited. Now let's put everything together for PayPal. We learned when looking at the stock that they go 5 for 6 on the Select 6 analysis and that they're only very slightly off when it comes to their average returns on capital. They're above average but just below what we wanted. The company's also slightly off with their current ratio, but that may not be something to be too worried about. While it's slowed, the company is back to growth. They've also bought back shares and sit on a cash pile while bringing in a ton of cash flow. Now, people ask me all the time, how do you find undervalued stocks? That's why I use this tool to show PayPal's fair value. Today it comes in at $92.84 per share, up $29 from their current stock price and $15 above their street target price. PayPal looks undervalued. To find more undervalued stocks, sign up for our investing tools and get exclusive bonus coverage of 88 stocks and counting.